across the major markets because of that. Right, come on, open. I'm told that I'm now live, so let's see what happens. Right, yes, I'm live, sorry. Hi everyone, welcome to the IX Trading. I'm really sorry we are a bit delayed today. We've had some connection issues with our YouTube channel, but we're now back in the game and we are now live in the IX Trading Room. Now, for the IX Trading Room, I have to stress that everything I talk about today is live market information and it's not to be construed as investment advice. That is important that you understand that. I'm not giving advice today. I'm just here for your guidance in terms of information purposes only, nothing more than that. Not advice. Very important. Right, okay, so on my Insta video that I just did, I talked earlier about the fact that I was going to be discussing all these crazy market moves we're going to see today. We're going to see some wild market moves on bond markets. This chart you've got here, this is on the IX1 platform. This is euro yen. Now this is the big mover of the day because basically the euro has been slammed and the yen has gone strongly higher. Bring all that together, euro yen falls massively, very sharply lower on euro yen. But I'm going to talk about the reasons why this is happening, and also looking at some of the bond market moves, what that means for European Central Bank, what it means for the Federal Reserve moving forward, all that going on. So lots to get through, so let's give it a go. Now, okay, so to try and sort of be very succinct about this whole situation, what we've got is all these woes that you've seen in the US banking sector were the issues that were affecting the dollar earlier in the week. Now I'll get dollar index up. You see that dollar index fell sharply earlier in the week as these banking woes of SVB and is it First Republic, something like that, and the bank in New York, I can't remember what it's called, Signature, that was it, Signature Bank. All these concerns have now been settled in the States. You've had President Biden coming out saying that depositors have got their money is covered, no worries, don't worry about it, nothing to see here. Although obviously concerns will still continue to be the case, but those concerns have now shifted into Europe, as today the announcement has come from Credit Suisse's largest shareholder, which is the Saudi Arabian Investment Fund, I think it was, will not be increasing its shareholding. Now, this is information that the market already knows. Market already sort of had an idea that this was going to happen. It's nothing really massively new, but it really scared markets. And subsequently, bank stocks fell massively in in Europe, across Europe, and that has really significantly hit the euro. The euro has fallen sharply. Trade-weighted euro, massively falling today. Look at that decline in the trade-weighted euro, huge sell-off on the euro. And basically, you add in that to obviously the concerns that they've got in the States, but also this afternoon or early afternoon, we've had the US PPI, which is the Producer Prices Index, falling more than expected, much more than expected, I should say. Let me show you. This is the calendar. Producer Prices Index 5.4 fell to 6.46% down to 4.6 on the headline and 5.4 to 4.4. That's a massive decline, massive decline in US inflation indicators. And the reason that is important, I'm going to show you my US inflation charts, is that this green line here is the PPI, core PPI, and you can see it basically certainly leads headline CPI lower, and to an extent core CPI. So this acceleration lower of core PPI is a lead indicator effectively for CPI later in the year. US inflation, consumer inflation falling later in the year. And what does that mean? Well, ultimately what that has done is we've seen that US Treasury yields have just plummeted back again lower. That 2-year was up at 4.4. It's now at 3.8. It's had a 60 basis point or 0.6% decline in a day. And again, that just massively brings it back once more to safe haven asset flows coming through the roof. You've got gold performing strongly. We've also seen an interesting chart that I'll show you here. If I can get this, show you the VIX. And what I'll do is I will explode that out. That becomes a widget. Open that out. Get rid of that. 2 moving averages. You see that a massive increase in US volatility on equity markets again. So equity market volatility is a fear trade. Spiking higher in the VIX is a fear trade. It basically tells us that markets are fearful of what is going to happen further down the line, because this is the index of options volatility. And when this is basically options pricing, when options massively increase, if the premium massively increases in price, that says that they're getting more expensive. That says that market's getting more fearful of what's going to happen, and everyone's piling in to short positions, or I should say, put positions on the on US equity options. So that's basically what's happening there. And this is all fear trade moves. So basically, we're seeing the likes of gold spiking higher. Let me show you gold. Gold has again spiked back higher. Not too far from that 1960 level of resistance now on gold. We've also seen that the yen, as I said, the dollar's strong today, but dollar yen is falling. The yen is falling sharply, and as you can see, on euro yen, that really is falling sharply there. So we're seeing market moves into these fear trades. Now, what does this mean going into tomorrow's ECB meeting? Well, European Central Bank was meant to hike by 50 basis points. There's a big question mark now over that. If it doesn't hike by 50 basis points, maybe 25, there are credibility questions for the European Central Bank then, because Christine Lagarde has been going on about, so basically pretty much did the 50 basis points rate hike in the last meeting and said, yeah, there's going to be another one in March. If they now only do 25, that means the euro will get slammed, probably even more so than it is a continuation of the move today. But also, there'll be question marks whether, even if it does hike by 50 basis points, does the European Central Bank then just massively to put out a dovish hike and put a big, very cautious message across with this 50 basis points hike? So there's plenty to ponder whether what the European Central Bank does tomorrow. Then looking forward, what does the Federal Reserve do? Well, I mean, if I talk about pricing, Fed funds futures, wow, okay, where are we at now? I mean, this is a big moving target at the moment. Fed funds futures 95.25. That is 4.75% on rates. There's basically no more rate hikes. That is slightly now 4.75. It's gone up a slight amount, but nothing too significant. Still 4.75. Basically, US rates staying still now. No more rate hikes in the States, according to Fed funds futures, which is the market's expectation of where Federal Reserve interest rates are going. So no more rate hikes. Look at this. That's basically the first rate cut is due in July. That's crazy. What was it, last week? Yeah, I mean, basically last week, the 8th of March, market was up at 5.69 in terms of the terminal rate. So 100 basis points above here, almost 100 basis points above here as the terminal rate. And it was like rate cuts have been pushed into Q2 2024. Well, now they've now been massive. There's massive, like that screeching sound you can hear is the sound of the massive brakes being put on, and they're now going into reverse gear so quickly, or so the market is pricing for that to happen. Now, what is more likely is that, I think, is that this is just a wild moment. And basically, once all this volatility settles down, this line will probably end up back around 5% again, or at 95. And that'll mean that there'll be room for probably another rate hike, 25 basis points from the Fed, probably. Because inflation is still an issue, I think that once markets begin to settle down, I still think that there's probably room for another rate hike, maybe one. But yeah, I mean, it's pretty wild at the moment what is going on in financial markets. But yeah, that's the Federal Reserve. I'm going to talk about the Federal Reserve again in more detail next week. But yeah, just wanted to sort of talk about it today. And obviously there is much going on. So, okay, that's interest rates. Now, where does this leave us in terms of market positioning? Well, I mean, putting trades on now, it's a massive gamble, because I mean, markets are so volatile today. You've got to think that if this continues and the European Central Bank does take a step back tomorrow, this euro dollar is likely to be way below. You'd imagine way below that 104.80 mark. So 105.40 now. That's only 60 pips away from where we are now. So I would say that it is likely that euro dollar would be falling away sharply. Obviously, huge volatility this week, and the question is, how much further does it go? I mean, if the European Central, because basically European interest rates are still priced to go towards 3.5%, that's another 100 basis points from where we are now. So it's 50 basis points tomorrow and another 0.5% after. Is there room to do that? Well, the European Central Bank has still got big inflation problems to cope with. Inflation is still very high, so there is still the need to be higher in interest rates. But there's this sort of dichotomy going on, this sort of contradictory pull effect on markets, where you've got obviously the concerns with the financial system. They are now growing significantly. Concerns of how these sort of huge rate hikes are impacting through the financial system. That is meaning that there is a possibility that all these sort of priced in rate hikes for future meetings could well be come off. But you've also got inflation to fight. Inflation is, the inflation in the States is falling, but inflation in Europe and the Eurozone is still pretty high. So yeah, there's a lot of volatility, I think, that's going to play out in the coming weeks, and you can see that already. I mean, bond market volatility just sort of come back here. Bond market volatility has again just absolutely spiked through the roof. This is bond market volatility. This is US Treasuries bond market. It's still bond market volatility. Wow. So when that happens, you're just massively playing on safe havens. So you'd imagine that that's the dollar continues to be the big outperformer. But I mean, these are crazy market moves at the moment. So it'll be interesting to see where this goes. But yeah, what to do, I suppose. I suppose near term, what my take from this would be that safe haven asset plays are the way to sort of stay. In terms of trading, I'd be looking at the likes of the yen performing well. Certainly, I mean, if bond yields continue to fall lower, the yen will be really strong. You're also likely to see the dollar as a safe haven asset play as well. I mean, the gold price, is there much upside? Yeah, I mean, there's no reason why not. I mean, gold has massively sort of rallied. And if I sort of zoom out here, there's still upside moves in this gold run higher. There's no reason why you can't sort of retest that spike high that we saw sort of March 22. I mean, we've seen the bond market volatility. I'll just go back to that chart. Bond market volatility higher than where it was back in certainly back in March, when sort of the height of the concerns about the Ukraine war. And also we've got, as I showed you earlier, the VIX volatility going up as well past that level that it saw in March. So gold being a classic safe haven play, there's no reason why not. So that's the issue. But obviously big volatility, and that when volatility comes into play, there are issues over sort of stop losses. How do you position stop losses when markets are so volatile? I mean, there are ways of doing it. I mean, you sort of, just off the top of my head, really, you sort of scale back your position size so you can take on a larger stop loss. Say, for example, I mean, if you're looking at, say, for example, a $50 stop loss on gold, you'd have to really scale back the size of the trade, the lot size of the trade, in order to have that. Because I mean, a $50, say for example, if you're trading a $1,000 account and you want to only risk, say, $50, which is 5% of the account, for $50 on gold, you'd have to have a 0.01 lot size on gold. I mean, that is the smallest lot size you can get. I mean, that sort of comes into play with a $50. If that's the trade stop loss that you're looking at, and you only want to risk $50, that's the trade size that you have to have. Otherwise, you're massively overexposed, and you can't have that stop loss. So these are the things that have to be considered when you're trading in volatility. And I mean, just for today, for example, the high-low range is what, $50, pretty much, low of 1885 up to 1935. That's a $50 swing on the day's trade. Well, that's only one day. So I mean, if markets turn again, and that's, who's to say that's not going to happen, because markets are so jittery, so volatile at the moment, you need to be aware that that sort of thing can happen. So just be mindful of that, I think, in sort of position sizes and stop losses that are so important, especially for sort of early trade or early day or beginner novice trades, or whatever you sort of want to call it. But yeah, just it's a very difficult time to be trading markets, because markets are so volatile. Yeah, you can catch a ride, and sort of the dollar continues to swing higher, and everything's golden if you sort of are on the right side of the trade. But if you're on the wrong side of the trade and you catch it and you sell it and the market flips against you, it will really turn nasty. So please, I would say, just bear that in mind. So yeah, thanks for coming, everyone, today. I really apologize for the late beginning to the webinar. That was a bit of a technical glitch our side, but we got there in the end, and it's been all, I hope it's been helpful. So what I'm going to do is I am going to just leave you with a quick video, which basically just sort of lets you know everything that we're doing, and with the trading orders, etc. So I wish you good luck in your trading, and I'll speak to you all next time. Thank you very much.